In this video, just following one of the tax tips, it can get you $56,000 of tax deductions for your business this year. And if you are married, that number doubles to $112,000 of tax deductions. How will you like them apples? 112,000 of them. Hey guys, this is Alan Chen with the Free Cash Flow Agency, and I'm a certified public accountant. First of all, thank you for tuning in. In this lesson, we want to give you the top 5 tax tips for those of you out there making $500K a year or more in revenue with sales. We generally gear these videos so that all the tax tips will have the highest amount of benefits if you fall into a certain range of revenue, and in this time, we are looking at you if you're making $500K to $1 million. Of course, if you're outside of this range, you can still benefit from a lot of these tax tips, but we want to, of course, caveat that by saying that this video is made for those specifically in that range. So let's start with tip number 1. In tax tip number 1, we have the family income splitting tax strategy. When you're making around $500K, you're right around the highest tax bracket in the US. And that is actually the most optimal level to start thinking about how family income splitting will be a huge benefit for your business. So what is family income splitting rule? It is a tax strategy where you can allocate some of the net profit or income in your business to family members that will work for your business, such as your son, your daughter, your nephew, your niece, your uncle, etc. by giving them a position in your company and letting them earn a reasonable salary for that role that they're taking on for your business. So for any business with more than, I would say, $300K in net profit, this can make a huge impact. And it is a move where some of your income that's taxed at the highest brackets, you can allocate them to the lowest bracket, netting you immense saving in between. But first, things to watch out for. The IRS is aware of abuse from this tax law, as believe it or not, some businesses used to hire over 20 members to join their family business. And that's fine, but then give them all odd titles like stamp boy or greeting lady, when they have no need for those jobs at all for their business. So what the IRS have done is impose what they call a kiddie tax. It limits the amount of unearned income a kid can earn. Now it used to be that you can just pass on income to your kid while them having to do an honest day of work. As long as you give them some bogus title in the company, or sometimes not even that, and you just basically write their name in your payroll. Well, Congress has really cracked down on that, but it's fine. As long as you're paying your child or any member of your family for legitimate work they are doing and giving them a reasonable salary. For example, if you're paying your 10-year-old $30 an hour to copy papers, that's probably gonna raise some flags. But if you do involve some family members and your son is able to take over operations for you, then this is a great opportunity for you to save a lot of money on your taxes, right? So if you do have a son who has a marketing degree and taking over your marketing, that's perfectly fine. If you have someone who is good at logistics and taking over, your partnership with your suppliers, that is great too. So just make sure that you're actually paying them a reasonable salary for the work that they are doing. And in that case, this is a great way for you to, strategize and make sure you don't pay more income than you have to. So to give you guys an example, so say Michael. Michael is an e-commerce owner making about $500K a year. And that puts him at the highest tax bracket in his category, right? So what Michael will want to do is, Michael just happens to have a son and a daughter. His son went to business school and is really good at finance and decided, hey son, why don't you run, do some accounting for me and I'll pay you $50K a year. The son says, sure, I need a job. I just graduated from college, haven't got any offers yet. And then he has a daughter. His daughter has a marketing and advertising degree, and he says, hey daughter, we're doing a lot of social media, we're doing a lot of Instagram, a lot of TikTok. Can you be our social media manager and also pay you about $50K? So what happens in this case is that because he paid his son and his daughter $50K each, his taxable income for his business just got lowered to $400K. So that put him out of the 35% range and puts him in the next lower bracket. And then his son and his daughter, both making $50K, are put in a much lower bracket, the 22% bracket. So as you can see from this chart, you save the difference between the highest bracket and the lowest bracket because you're able to move some of your income to other family members that's still part of your operation. But then you yourself as a business owner don't have to pay as much taxes because you're able to split that income around to your families, which just benefits everyone, right? everyone in your family. So in tax tip number 2, we have the solo 401k. Let's talk about how amazing the solo 401k plan is. So the plan is solely created for small business owners that are operating by themselves. You can have up to one business partner with limitations, and you can have your spouse working in your company, but that's it. Okay? So the crazy thing about solo 401k plan is they operate on a self-directed custodian. So what does this mean? So a traditional custodian is one such as Fidelity, Vanguard, that will only allow you to invest in very traditional investment vehicles, right? Such as stocks or bonds or mutual funds. But a self-directed custodian is kind of crazy. You can invest in things like, crypto, artwork, gold, and just different things like that, where you really have unlimited choices of what you want to invest that money in. Now, do I recommend that you do that? No. But it does give you a lot of choices. You can also invest in land, bankruptcy, real estate deals if you really wanted to. But just let you know, it gives you great options, right? So it's self-directed. So anyway, back to the topic. So what makes solo 401k amazing is the crazy rule that you can contribute as both the employee and employer of the business. The employee part of the business is called elective deferral, which you might be familiar with if you ever worked for a company. For 2021, that number is $19,500 if you're under 50 of age. The employer part is called the profit sharing, and the max you can take in that part is $38,500. So if you add these two amounts together, you can contribute a maximum of $58,000 to this plan, which is insane, as we mentioned, a traditional 401k, say if you work for an employer, only allows for $19,500 a year. And this is why they encourage people to start businesses. There's outstanding incentives like this that the government have set up to stimulate entrepreneurship, making it all worthwhile to be your own boss. And get this, if your spouse works for you, that amount doubles. Yes, that means technically you deduct $116,000 of your income into the solo 401k retirement plan and have it be shielded from income each and every year. It's pretty incredible. One thing to keep in mind is the profit sharing plan does have a limitation, right? So if you are a sole proprietorship or partnership, you're limited to 20% of your net income. If you're an LLC or S Corp, you're limited to 25% of net income, which means you do need to make a certain amount to get the full deduction. But right around the 500K mark, you would meet this criteria and be able to deduct the full amount and get that $58,000. Incredible. In tax tip number 3, we look at raises and benefits. And basically, we want to tell you that if you want to save on employer payroll tax, a valuable employee perk may be the better way forward. The IRS has a guide on what's taxable and what's not, but some of the benefits that your employees won't pay tax on include company cell phones, up to $500,000 in life insurance coverage, some employee meals, occasional tickets to sporting or music events. Note that the IRS considers gift cards, even small ones, taxable as income unless it's under $25. If you want to avoid additional tax burden, giving a small birthday gift like a fruit basket may offer some tax savings also. And anything considered trivial or minor to merit consideration carries no tax burden. That would be something under $25, which you can give away all day. So you should ask your tax professional how additional benefits like tuition assistance or retirement planning service can count as expenses during tax time without triggering additional payroll or income tax liability for you and your worker. So this is a great way to basically give some benefits to your employees, get incentive for them to stay with your company while not creating additional tax burdens for your company. So definitely look into those tax benefits. And tax tip number 4, make sure you pay attention to your sales tax threshold and where you might cross that threshold as you hit 500K in revenue. As you cross that 500K mark, you're getting to the point where you'll most likely need to establish sales tax permits every state that you have customers in. You should definitely start, of course, with your state of residence or where your business is. And then the next one you want to check for is anywhere where you have physical nexus. So the question we're going to get right now is, what is nexus, right? What does that mean? Nexus is defined as a connection or affiliation to an area that triggers sales tax. That's all. There's 2 main ways you can trigger nexus. One, physical presence, and the other, economic condition. Here are some common activities that will trigger physical nexus. So if you have an office, store, or other location in a state, that's one of the most common ones. Employees salesperson, contractor in that state, owning a warehouse or storage facility, storing inventory in a state, so Amazon FBA warehouses and other third-party fulfillment center will fall under this category, having a third-party affiliate in a state, or the last one is temporarily doing physical business in the state for limited amounts, such as at a trade show or craft fair. After this level, you will want to check for what is called economic nexus. That is when you have enough concentration of sales in a certain state that will require you to also remit sales tax to that state's government. It is important to be proactive here and not wait until that state comes after you, as at that point you have incurred penalties and fees, and you don't want that to happen, as that is just giving free money away. And for some states, that can be up to as much as 20% of the amount that you have paid originally, and 20% add on top of that. So make sure you stay ahead of the game there. By knowing what's each state's threshold, you're more likely to be able to implement tax planning strategies around it and possibly not have to pay for certain states' sales tax if you're able to stay right under it. And that's something we're very eager to always help our clients on, to make sure that they can minimize their taxable liabilities in the most legal way possible, just playing by the rules that every state has come up with. Cool. Now, last but not least, and tax tip number 5, we want to talk about something no small business owners should pass up on, and that is the qualified business income deduction, otherwise known as QBI. QBI is a tax deduction that allows eligible self-employed and small business owners to deduct up to 20% of their qualified business income on their taxes. After the Tax Cuts and Jobs Act was passed in 2017, the IRS allowed for some business entities to deduct up to 20% of qualified business income, as well as 20% for qualified real estate investment trusts, REITs, that this will offer substantial savings when taken in addition to itemized deduction or the standard deductions. Most solo proprietors, partnership and S corps, and some estates and trusts qualifies for this, but of course some businesses are excluded. Now, your total taxable income in 2020 must be under $163,300 for single filers, $326,600 for joint filers to qualify. In 2021, the limit rises to $164,900 for single and $329,800 for joint filers. Once you're over this limit, the phase out happens, and you're very limited to how much you can claim under the QBI. This brings up an important point. You should always try to stay under this taxable income limit, and the best way to do this is to understand all the available tax deductions that you can take to lower that taxable income number to as low as possible, so you can qualify for this deduction and a lot more. So don't forget to do this year. Don't forget to make sure to see if your business will qualify for this, and make sure that you're doing the proper tax planning and evaluation to lock down a QBI deduction for your small business this year. 20% is a big deal, and for those of you making around $500K, this is very within reach for you guys. Very much within reach. So make sure you look out for that. Anyway, if you'd like to learn more in depth about topics like this, check out links in the bio for our online course titled Tax-Free eCom, Hyperdrive Your After-Tax Profit. Learn how you can save tens and even hundreds of thousands of dollars on your taxes each and every year. And business strategies that will open your eyes on all the advantages that you should be using that billion-dollar companies utilize to grow their business and pay minimized taxes. You don't want to miss out on our limited time pricing we have going on right now, which is sure to go up, as our students have told us that the return on their investment for getting this course is hilariously high. Awesome. Well, that's it for now. I hope you guys learned a great deal from this video. We want to make more of this type of content for you guys. So if you find it useful, or if you have comments or questions, please make sure you put it in the comment below, and we'll try to make a video to address your needs. Also, if your business is looking for an all-in-one solution to save on taxes and have amazing bookkeeping done on your behalf, then click the link in the description and pre-book a free consultation call with FCF agency, and we will see if we'll be a great fit together. We only take on clients we know that we can really help, as we want only happy clients here at Free Cash Flow. That's it for now. If you enjoyed this video, I appreciate if you give it a like and a subscribe, so you don't miss out on any tax advice that will help your business save even more money in the future. And of course, it'll motivate us to put out more value pack, business, and tax video for you guys. Thank you so much. Have a great day ahead. Peace.